there is a question almost nobody is asking, and yet it may become one of the most important financial questions of this decade. Who is going to keep buying America's debt? For years, the answer seemed obvious. Foreign governments bought it. Central banks bought it. Institutions bought it. Investors bought it. The system appeared strong, stable, and almost impossible to challenge. But today, cracks are beginning to appear. And if those cracks continue to widen, the consequences could reach every American household. When people hear the word debt, they often imagine something distant, technical, or boring. They think it belongs to economists, politicians, and financial experts. But debt is not just a government issue. Debt influences interest rates, mortgages, stock prices, retirement accounts, business investments, and even the value of the money sitting in your bank account. The reason I pay attention to debt is simple. Throughout history, the rise and decline of great powers has almost always been connected to how they manage their finances. The United States has accumulated an enormous amount of debt over many decades. At first, this was manageable because the economy was growing rapidly, confidence was high, and investors around the world trusted America more than any other country. U.S. Treasury bonds became the foundation of the global financial system. They were considered one of the safest assets on earth. If you were a government with large reserves, you bought treasuries. If you were a pension fund, you bought treasuries. If you wanted safety during uncertainty, you bought treasuries. But something important has started to change. The amount of debt being issued is growing faster than the pool of willing buyers. Think about it this way. Imagine a company that keeps selling more and more shares every year. At some point, investors begin asking whether demand can keep up with supply. The same principle applies to government debt. If supply rises much faster than demand, the system eventually faces pressure. The challenge is not that America suddenly became weak. The challenge is that the numbers are becoming increasingly difficult to ignore. Every year, the government spends more money than it collects. That difference has to be financed through borrowing. Borrowing creates more debt. More debt creates larger interest payments. Larger interest payments require even more borrowing. Over time, this cycle can become self-reinforcing. What makes this situation particularly important is the size of the financing requirement. The United States does not simply need buyers for existing debt. It also needs buyers for new debt being issued every year. That means demand must remain consistently strong. If demand weakens even slightly, borrowing costs can rise significantly. Now, many people assume foreign countries will always step in. For decades, nations around the world accumulated U.S. treasuries because they wanted a safe place to store reserves. But geopolitical tensions, changing economic priorities, and the desire for diversification are causing some countries to reconsider how much exposure they want. This does not mean they are abandoning America. It means they may not be increasing their purchases at the same pace as before. That distinction is crucial. Financial systems do not usually break because everyone leaves at once. They experience stress because fewer new participants arrive while supply keeps expanding. The imbalance grows gradually before it becomes obvious. History offers valuable lessons here. When nations become heavily indebted, they often face difficult choices. They can reduce spending. They can raise taxes. They can allow inflation to reduce the real value of debt, or they can continue borrowing and hope growth eventually solves the problem. None of these options are painless. Every path involves trade-offs. One mistake investors make is believing that reserve currency status guarantees permanent protection. The U.S. dollar remains the world's dominant reserve currency, and that is a tremendous advantage. But history shows that no financial system remains unchanged forever. Dominance creates strength, but it can also create complacency. The question is not whether the dollar disappears tomorrow. The question is whether demand for dollar-denominated assets can continue keeping pace with the growing supply. When governments issue more debt, then markets comfortably absorb. Interest rates often become the pressure valve. Higher rates attract buyers because investors receive greater compensation. But higher rates also increase financing costs throughout the economy. Mortgages become more expensive. Business loans become more expensive. Consumer borrowing becomes more expensive. Economic activity can slow. This is where the situation becomes complicated. Policymakers want economic growth. Investors want stable markets. Borrowers want lower rates. Savers want higher returns. These objectives do not always align. As debt levels rise, balancing these competing interests becomes increasingly difficult. Many people focus exclusively on the stock market. They watch daily price movements and assume rising stocks mean everything is fine. But debt markets are often more important than equity markets. The bond market determines the cost of money. It influences nearly every financial decision in the economy. When the bond market sends warning signals, investors should pay attention. Another issue rarely discussed is confidence. Financial systems ultimately depend on trust. Investors buy government debt because they believe they will be repaid. They believe inflation will remain manageable. They believe institutions will remain functional. Confidence can persist for a very long time, but once it begins to weaken, restoring it becomes much harder than maintaining it. That does not mean panic is justified. Panic is rarely productive. The goal is not to predict disaster. The goal is to understand risk. Too many people think risk means a sudden collapse. In reality, risk often develops slowly. It emerges through small changes that accumulate over years. Consider what happens if interest payments consume an increasingly large portion of government spending, money that could be directed toward infrastructure, education, research. Flexibility decreases. Policymakers have fewer options. Economic resilience weakens. The reality is that debt itself is not inherently bad. Businesses borrow to expand. Families borrow to purchase homes. Governments borrow to invest in the future. Problems emerge when debt grows faster than the income needed to support it. This is why debt cycles matter so much. During the early stages, borrowing stimulates growth. During the later stages, servicing debt becomes a growing burden. Understanding where we are within that cycle helps investors make better decisions. One of the most important principles I have learned is that markets move in cycles, not straight lines. Optimism eventually becomes excessive. Pessimism eventually becomes excessive. The same applies to debt. Borrowing can remain sustainable for longer than many people expect. Then suddenly, concerns that seemed unimportant become central. Some investors believe the Federal Reserve can simply solve any debt problem by creating money. While central banks possess powerful tools, those tools come with consequences. Expanding the money supply may support liquidity, but it can also contribute to inflationary pressures. Policymakers must constantly balance competing risks. Inflation deserves special attention because it functions like a hidden tax. When prices rise faster than incomes, purchasing power declines. Savings lose value. Long-term planning becomes more difficult. For debtors, inflation can reduce the real burden of obligations. For savers, it can be damaging. This creates another challenge. If investors believe inflation will remain elevated, they demand higher yields to compensate for that risk. Higher yields increase borrowing costs. Higher borrowing costs increase fiscal pressure. The cycle feeds itself. What should ordinary people take away from all of this? First, understand that diversification matters. No one knows exactly how future debt dynamics will unfold. Building resilience is more important than making dramatic predictions. Diversification across asset classes, industries, and economic environments can help reduce vulnerability. Second, focus on quality. During periods of uncertainty, strong balance sheets become increasingly valuable. Whether evaluating businesses, investments, or personal finances, financial strength matters. The ability to withstand shocks often determines long-term success. Third, avoid assuming recent trends will continue indefinitely. Human beings naturally project the present into the future. If markets have been strong, we expect strength. If rates have been low, we expect low rates. History repeatedly demonstrates that cycles eventually change. Fourth, pay attention to incentives. Economic outcomes are often shaped by the incentives facing policymakers, corporations, and investors. Understanding those incentives provides insight into potential future developments. The most important message is not that America is doomed. It is not that collapse is imminent. It is not that investors should live in fear. The message is that financial realities eventually matter. Debt levels matter. Interest costs matter. Supply and demand matter. Confidence matters. Throughout history, the strongest societies have been those willing to confront challenges before they become crises. Ignoring problems because they are uncomfortable does not eliminate them. Understanding problems creates the opportunity to address them. The United States remains one of the most innovative, productive, and influential nations in the world. It possesses extraordinary strength, including deep capital markets, world-class companies, leading universities, entrepreneurial culture, and significant geopolitical influence. Those strengths should never be underestimated. At the same time, strengths do not eliminate constraints. Every nation, every company, and every individual eventually encounters limits. Sustainable success requires recognizing those limits and adapting accordingly. So, when I say America may be running out of buyers, I am not making a prediction about tomorrow. I am highlighting a trend that deserves attention. The question is not whether buyers disappear overnight. The question is whether demand continues matching an ever-expanding supply of debt. Because if supply keeps rising faster than demand, markets will adjust, interest rates will adjust, asset prices will adjust, economic expectations will adjust, and those adjustments can affect everyone, whether they follow financial news or not. The biggest financial shifts often begin quietly. They do not announce themselves with headlines. They develop gradually, beneath the surface until one day people realize the world has changed more than they expected. The investors who succeed are usually not the ones who react first to headlines. They are the ones who recognize important trends before everyone else notices them. And right now, one of the most important questions facing the global economy is a simple one. As America continues issuing more debt year after year, who will be there to buy it? The answer to that question may shape markets, economies, and investment outcomes for many years to come.